while you're on the phone call tonight, maybe you've already invested in some tax liens or attended a tax deed auction. Maybe this is just something you've been thinking about started, but this is definitely the first step in becoming successful in tax liens and deeds. We've helped a lot of investors, and I want to be able to help you go out there and be successful too. Over the last 6 months, we've kind of taken a break from training to focus on personal investments, and so we haven't done a lot of trainings over the last 6 months. And really, the reason we decided to start doing trainings again is because how much we love doing it. There's nothing that brings more joy to me to be able to see an investor go out there and make some good money. If they can go out there and pick up a property and I get that success story, hey Steve, check out this tax deed I purchased. I'm at step 2. That makes me feel great. If an investor goes out there and is earning a great interest rate on their money, they had it in the bank earning 0.5%, and now they're earning 12% or 16% or 18% on their money. I feel good about that because I know they're making a better investment. That's the reason I got excited back in 1990 about tax lien investing and haven't quit talking about it since then. I probably drive people nuts talking about it because I see, I even have family that had so much money in the stock market, and over the last, after 9/11 and between that time, they were invested in the very safest stocks and lost half of their money, half of their retirement, boom, gone. If they would have been invested in tax lien certificates, they'd be earning 18% on their money. They would be earning money each year on it. And now finally, I've been able to bring some of my family members and start investing in tax lien certificates and tax deeds because there's just a great opportunity. That's the reason you're on the line this evening, and let's go ahead and get started talking about it. So why tax liens and deeds? Well, first of all, tax liens are one of the safest investments available today. They're one of the highest yielding investment strategies. You can compare a tax lien certificate to a stock, a CD, a mutual fund. Generally they're going to be as high, if not higher, than many of those investments, and they're also going to be guaranteed. Tax liens can earn 12, 16, 18%, even 25% per year. Now, as far as tax deed investing, tax deeds can be purchased and sold quickly for lump sums of some returns. They can also be rented or leased for monthly residual income. So with tax deed investing, you're really looking at that like a real estate investor. With tax liens, you look at it as an interest rate return with the chance to get a property. Mostly you're going to be earning an interest rate return. With tax deed investing, you're acquiring the property. It's just a different form of foreclosure. So, it's a foreclosure because of taxes versus a foreclosure because of mortgage. And usually tax deeds are going to be sold for a lot less, because when you're looking at a mortgage foreclosure, they may have a mortgage that's worth more than the property. So they can't take that big of a hit. With tax deeds, the only thing the county can charge, as far as that beginning bid amount, is how much is delinquent in taxes. So instead of starting at 95%, you're starting at 5, 10%, 15%. And so there's a lot larger room for profit. And that's what the reason you're on the call and you're interested in tax liens and deeds is because you're looking to make a profit. And that doesn't matter if that profit's 18% or 16% on your money, or if it's going out there and acquiring property. Either way, I think it's the best of both worlds. That's the reason I'm so excited to talk about it. Now, redemption deeds, they offer property rights with a higher interest rate, with a high interest rate return. So redemption deeds are a tax deed with a redemption period, and we're going to get into it in more detail here in a little bit. Okay, now these are a couple of investments that we made last month. I wanted to show you guys a couple of recent deals that we were able to do. These are 2 Florida tax deed properties. Now, the first property is a single-family home, 3-bedroom, 2-bath. It's valued about $52,000. Now, we won this in the auction for about $10,100. Now, with this particular property, we're going to do it as a rental. We're going to do a rent, and so we're going to rent it out at $900 a month. So if you're looking at that $900 a month and looking at a $10,000 bid, well, within a year's period of time, this property will pay for itself. Now, I mean, you know, you think about that. You know, a property is able to pay for itself within a year, and then from there on, you have a cash flowing property. You know, there's not a lot better than that. Uh, Here's another Florida tax deed. Another single-family home, 3-bedroom, 1 bath. It's worth about $65,000. This one we paid a little bit more for. We paid $20,700. We're going to sell it for $60,000, so it's going to have a $36,000 profit. And so these are two examples that we were able to do within the last 60 days. And so there is opportunity out there. You just want to make sure you're making a good investment. That's really the key, is just making sure that you're picking up a good property, and the property may sell from anywhere between 10 to 30%. Now with tax and certificates, it's going to be a little bit different strategy. There is strategies to acquire property through tax and certificates, and it's really tax liens that are past their redemption period. And that's something that you can do through the secondary market. And so we're going to talk about that a little bit later. Now, why tax liens and deeds? We went through that already. So what is a tax lien? Well, first of all, a tax lien, by definition, is a claim against an asset, in this case real property, filed by a government taxing authority against a delinquent taxpayer. And really, guys, there's three types of tax sales. There's tax liens, there's tax deeds, and there's also redemption deeds. So let's get into the property tax basics. Now, as far as property taxes, they're also called ad valorem taxes in many counties. The local governments, they operate independent of the federal government, so the property taxes represent the single biggest form of revenue for the counties. This is going to go to pay for the education, the police. Now, the actual laws that govern the enforcement of property taxes are going to be written on a state level. So the state writes the laws, and then the county follows those state guidelines to conduct the auctions. Now, the actual property tax rate, it's going to be based on a combination of property value and the county's estimated budget for the year. And so that's when we talk about the assessed value, that's how they come up with the property tax rate and come up with that assessed value, is by a combination of the property value within the county and then the county's estimated budget. And so we're going to go through that in a little bit later. Now here's the property tax cycle. We can see the property owner down here, the county government. Now the property owner is going to go ahead and pay property taxes to the county government. The county government uses that money to provide local services, like we talked about, the police, school, education. Now, as far as that property tax rate, here's an example to kind of give you an idea. Now, this $1 million is the estimated budget for the county services per year. Now this is, of course, we're just using this for numbers' sake. Usually counties are going to have a larger budget. But at $1 million, that would be the county's budget. Now that county has $100 million worth of real estate. So the county assessed value for the real estate within that area is $100 million. And so at that, with the 1 million versus 100, that's going to give us a property tax rate of 1%. So a home valued at 100,000 would have a $1,000 tax bill. And so if this property tax rate was 2%, then that would be a $2,000 tax bill. And so it really just, is going to be based on the property tax rate within that area. And that's the reason some areas have a higher, tax liens than other areas, even though the real estate may be valued about the same. It just depends on how big that county budget is, and the bigger the county budget, the higher the property taxes. So what happens if the property owner doesn't pay their annual property taxes? Well, the county relies on the property tax revenue to function. So the property taxes need to be enforced. If they weren't enforced, people wouldn't pay them. And so that's really what brings us into the property tax enforcement systems. And there's three systems that are used within the United States. There's the tax lien system, there's the tax deed system, and there's the redemption deed system. Now, as far as tax lien certificates, tax liens are an enforcement method used by the county for the collection, used by the county government for the collection of property taxes. So tax liens are going to be offered to investors that are willing to pay off the delinquent tax liens. and usually you're going to purchase tax liens at a live auction or over the counter, or in the last couple of years there's the secondary market. So tax liens pay investors a rate of return, and they also give property owners a redemption period to repay the taxes. Now if the tax lien redeems, the investor will be paid back the principal plus the interest rate return. So if you invest $1,000 at 18%, you're going to make back $180. If you invest $10,000, you're going to make back $1,800 if that tax lien went for a year. Now, tax liens have foreclosure rights. This is one of the greatest thing about tax liens is they have that foreclosure right. If a tax lien is not paid back within the redemption period, then the lien holder can foreclose and become the property owner. So with tax lien certificates, we're really looking at it through the idea of earning an interest rate return. Now, unless you're purchasing foreclosure-ready tax liens, most tax liens are going to pay off. About 95% of your tax lien certificates will pay off during that time frame. But of course, there is properties that are acquired through tax lien certificates, and tax deed states also sell property. So if a lien's in tax lien states, the county will issue a tax lien against the property. We can see the county government here issuing this tax lien. Now this is going to prevent the sale of the property. It can also lead to the property foreclosure, and it's also going to lead to delinquent taxes and more penalties. So the county is going to hold a tax sale where these tax liens are going to be sold to public investors like you and me. We can see this tax lien certificate here on the property, earning an 18% interest rate with a 2-year redemption period. It's going to be issued by the county. We're going to have the chance to purchase those tax liens, and we're going to start earning that interest rate on our money. Now, 2 things are going to happen on the day of the sale. First of all, the lien is going to start accruing interest. So that 18% or 16% or 12% is going to start earning. Also, the redemption period is going to begin at that time as well. So those are the 2 things that are going to happen on the day of sale. So as we're looking in tax liens that happened a couple of years ago in over-the-counter or secondary market, we're going to look to see when that auction initially took place. That's when the lien's going to start accruing interest. Now, after you purchase the tax lien, really 2 scenarios. First of all, the property owner is going to pay the county. So when the property owner pays the county, the tax lien certificate is removed. Now, if the property owner doesn't pay the county, that's where us as lien holders have the foreclosure right. We can exercise that right and foreclose on the property. So in scenario 1, if the property owner doesn't pay, if the property owner does pay, then the county government is going to cut a check to us as the investor with our investment plus the high interest rate return. In the scenario 2, if they don't pay, then of course we're going to use that lien to foreclose on the property and become the property's owner. Now let's go ahead and get into the tax deeds. Tax deed states have the same objective as tax lien states, and that's to collect delinquent property taxes. But what tax deed states do is they don't sell tax liens on an annual basis. So what tax deed states do is they wait until the redemption period is passed, and then the county will begin the foreclosure process. So the tax liens are going to be foreclosed on by the individual counties. Now, after the county forecloses on the property, they're going to create what's either called a tax deed or sometimes it's called a quitclaim deed. Then the county is going to offer the property deed for sale at usually a public auction. Now, there is a couple of other types, sealed bid, but usually it's going to be some type of public auction, either at the county courthouse or county approved building, or many auctions are also taking place online. Now the winning bidder will be awarded the property, and so with tax deeds you're actually acquiring the property. It's property ownership. So states that use tax deeds give the counties the power to foreclose on the delinquent property after the redemption period expires. So they're going to have a redemption period as well. They're going to have a period that they have where they'll allow the property taxes to be delinquent. So they'll say, okay, we'll give the property owner 4 years. We're going to keep sending them out letters, letting them know if they don't pay it over those 4 years, then we're going to foreclose it and we're going to sell it at the auction. So it's a pretty easy concept when you just think about it like that. And as far as tax and certificates, you're just earning that lien against the property. With it, as far as tax lien investing, it's really a win-win scenario. The county's going to win because they were able to get the money they need to function. The investor is going to win because they're earning an interest rate return, and the property owner is going to win because they're going to give extra time to pay their property taxes before they lose their property. With tax deed states, the county takes that right, they foreclose on the property, they offered it up at the auction. So as far as getting started with tax deeds and some tips and ideas, the opening bid amount is usually going to reflect about 5 to 10% of the property's value. The opening There we go. Let me get back. The opening bid amount usually won't be the purchase price for the tax deed sold at auction. Many times, you may bid up on those properties that I showed you. One of them started at $15,000. One of them started at $5,000. So we bidded up the property. That's usually how it's going to take place. There may be properties that don't bid up or that don't have bids. And they may be good properties. It's just about looking a little bit more into them. But most tax deeds are going, or especially the best tax deeds, are going to bid up somewhat in price. Now the bidding is going to start at that minimum amount, and then it's going to bid up in price until the final bid is established. Also, tax deeds can sell from the opening bid up to the market value, but usually they're going to sell anywhere between 20% to 50% of the property's value. A real nice property and a real high competition may sell up, that 50% mark, but usually that's where you're going to see the properties. And so it gives investors a lot larger margin to make profit on these properties, because when you're picking up property for 25% of its value, there's 75% profit that can be made. And so there's just a lot of options. It's really one of the best ways to acquire real estate for the cheapest. I have not found a cheaper way to get property. Now, tax deeds property can be purchased all over the county. Some counties and some states have over-the-counter tax deeds available. Okay, now let's go ahead and quickly go over the last enforcement system, and that's the redemption deed system. These are going to be states like Texas, states like Georgia, and redemption deeds are similar to tax liens and tax deeds. Redemption deeds are a hybrid of both. So redemption deeds are tax deeds with a redemption period. Now redemption deeds have redemption periods that range from 6 months to 2 years. Also, in addition to that, redemption deeds pay excellent returns. Georgia is 20%, Texas is 25%. Also, states like Texas, they have ownership rights extended to the deed holder, to the investor during the redemption period. And so essentially what the redemption deed states do is they issue the deed in your name. They're just not going to record the deed until after the redemption period is all over. Now, what redemption deeds differ from tax and certificates is, first, you're getting that deed. Some states will give you, ownership rights so you can, live in the property. You just don't want to put a lot of money into it in case the property owner redeems. But what separates them is it's a penalty versus an interest rate return in most redemption deed states. So instead of being 18% broken up over a year, going out to 1.5% per month, like a tax lien certificate in Florida, or 16% in Arizona, redemption deeds offer that full payout regardless of when the redemption deed redeems. So in Georgia, it's a 1 year redemption period. They pay out a 20% penalty. So if you were to purchase one of these redemption deeds, then if it redeemed after 1 year, you would make 20%. If it redeemed after 1 week, you would make 20%. So if the property owner redeems early, you can really double, triple, quadruple that interest rate return. If not, after the year period, then you're going to become the property owner. So it's really just a win-win scenario with redemption deeds, but the thing about redemption deeds is you usually need to be there in person. They're a great investment because they offer a good return with a higher chance of getting the property. So let's talk about selecting your investment strategy. Really, the first step in getting started is to determine what your investment strategy is going to be. So here we have kind of a graph of how this is done. The first thing you're going to do is you're going to select a strategy. There's lots of different strategies out there. From there, you're going to locate a state and a county. From there, you're going to obtain a tax sale list. And as far as this, there's really a pattern to be able to do this. As far as selecting a strategy, because you're on the call tonight, you're going to have access to the investor profiles. You can go through the investor profiles, and it's going to help you determine what strategy you'd like to get started with. In fact, we need to add one more profile to that, and that's the secondary market profile, or the secondary market investor. And so that's the profile I'm coming up with, and we're going to add that to the website. Once you've determined your investor profile, then you can locate a list or locate properties. So obtain a tax sale list. You can get those off of the secret websites. You can get them from the counties directly, from the county websites. From there, you're going to narrow your selection, narrow that list down, do the due diligence, and make the investment. And so we're going to go through and talk about some of these. We're not going to get to the last two just because we don't have the time, but we're going to get into that first part as you're going to go through it. So the first thing to think about is, are you going to be investing for yield or investing for property ownership? Investing for yield, you're looking to generate the highest interest rates possible. It's a guaranteed investment. It has high security. It's a way to build retirement. In fact, we have a lot of investors that have 401k accounts. And they have an old 401k they're not using. They want to turn that over to a self-directed IRA. If you're making 3-4% on your money in your IRA account and you're seeing that return come in, well, why not put that in tax lien certificates where you have a chance to get the property, plus you're going to earn a higher interest rate return. And so a lot of investors are taking their old accounts and turning them into self-directed accounts and using it to purchase tax lien certificates. It's a great way to build your retirement. Less time to dedicate, less burden, less hassle. With tax lien certificates, you're not going to be acquiring the property in most scenarios. And so you're just going to be earning an interest rate return. You don't have to put a lot of time and effort into it after you purchase that tax lien. You just wait until the property owner pays. You go ahead and make your interest rate, invest in another tax lien, or if they don't, then you can foreclose on the property. And at that point, if you purchase good tax liens, it's on such a great property, it's like hitting the lottery in a lot of ways. Investing for ownership, you're looking to replace your income. You're looking to generate lump sums. It's going to take more time, more money. May require travel. It's going to be more work. But you can earn those large lump sums. You could turn around and sell a property and make 30 grand or 50 grand or 100 grand or 200 grand. Really the sky's the limit. There's big properties all over the country that sell at tax deed auctions. So the first thing you're going to do as we go down that I don't keep trying to think of the name of it, just that graph in a way. As we select a strategy, and this is where we're going to do this with the investor profiles. And so we have different profiles available on the website. You're going to see them in the profile section. That's where we have the state profiles and the investor profiles. And you can go through and read about the different profile types. A high yield tax lien investor. There's 7 different profile types, and they're going to give you a good idea of what you can do with that profile, the different states you're able to invest in. So each one of these profiles are going to have the list of the states where you can use that profile. So as a high yield tax lien investor, here are the states you can look for earning high interest rate returns with tax liens. And so that's going to help you narrow down. Suddenly you go from 50 states to 20 states or to 10 states, and that helps narrow down so you're not spending so much time looking at areas that you may not even want to invest into. Helps narrow that down. So once you've selected a strategy, then you're going to locate a state and county. You're going to do that through going through those state profiles, looking at a couple of states you're interested in. Maybe they have auctions coming up. Maybe they have over-the-counter. From there, you're going to obtain a tax sale list. Uh, First, we're going to go through the state profiles real quick. So each state is going to have one of these state profiles. It explains the bidding types, the rate of return, the redemption period, assignment purchasing, auction dates. It even has the law written down plus the profile. It's going to really give you a good understanding of each one of those states as you go through and read those profiles. So essentially there's 50 states and there's 3,300 counties and municipalities. So that's a lot to begin with. That's the reason a lot of investors get overwhelmed. My goodness, there's 50 states. How am I ever going to find where I want to invest? And that's what we do. We try to funnel you down this process, this training process and decision-making process to determine your investor profile. That's going to narrow down 50 states to 10 states, 600 counties. From there, as you review the state guides and auctions coming up, just depending on what your what your strategy is, you're going to pick one or two states. That's going to narrow it down to 10, 20 counties. And from there, you can pick one or two counties to get started with. And so, that's really the process that you're going to go through is you're going to review the investor profiles. And because you're on the line, you're going to have access to them on the website. You're going to review the state guides, pick a state to get started with, start reviewing some of those counties, look at some of the lists that are available, see if they have auctions coming up, and then choose a county and a state to get started with. So there's really a couple different types of auction list. First of all, there's pre-auction list. These are the list before the auction takes place. And so these are, obviously upcoming auctions. There's also the post-auction list. These are what we call over-the-counter assignment purchasing list, secondary market list. These are tax lien investments that are available after the auction has taken place, where you can go and purchase them over the counter, either over the counter through the county, over the counter through a secondary market, and just really whatever type it is, it's going to be those over-the-counter properties. And now each list is going to be classified according to the enforcement system that is used. So a tax lien list, a tax deed list, a redemption deed list, those are going to be classified, those different investment types. The list will be classified that way. So we're going to get into just a little bit of the due diligence and narrowing your selection, but that's really something that we're going to go over next week and also tomorrow evening as well. We have another webinar. We have two webinars this week because we have the website training webinar as well. And so you guys will have access to that. If you'd like to attend that webinar, you can attend that webinar as well, where we're going to get into narrowing down the selection, due diligence, and then making the investment. But let's go over a few points this evening. First of all, once a tax sale list has been obtained, the next step is going to be to identify potential investments. Now, this can be done in most cases online. County websites have made such a difference in tax lien and deed investing. I mean, even when I first got started, you couldn't find over-the-counter lists available online. There was maybe one or two counties, and from then to now, so much has changed. Almost every county has county records available. Most of the counties have partial search tools where you can review the county records online. It makes, there's just so many tools available to us that weren't available to us 10 or 15 years ago. And that's the reason really the internet has revolutionized tax lien and deed investing. Most times, the tax lien auction or the tax sale auction was just the local people. If it was a big area, then you may have a few out-of-state investors, big pocket investors that are looking to spend millions of dollars. Otherwise, it's mostly local. Now with the internet, we can do auctions online. We can do research online. It makes tax lien and deed investing a lot easier for us as investors. Now, for tax liens, the objective is to make sure the property has value. When I'm looking at a tax lien certificate, I'm not interested in geography. I'm not interested in, really even what type of property it is. It could be a residential lot. It could be a residential property. It could be a commercial lot. It could be a commercial property. It could be a large tract of land. Really what I'm looking for is property value. You know, because an acre that's out in the middle of Arizona that's nothing but rattlesnakes and sagebrush that's only worth $500 versus a 1-acre lot in Connecticut that's you know, a commercial lot that's worth $80,000. There's a big difference between those two same 1-acre lots. And so what I'm looking for is I'm looking for value. And as far as tax lien certificates, if I see that value, then I'm going to invest in the tax lien. You know, I'm not going to worry about doing huge amounts of due diligence on the property because I can see the value of the property, get a look at the property, and I can make a good investment. 95% of the time, I'm just going to make back my interest rate return. Now, the primary objective for tax deeds is to determine the estimated property's value. That's what's most important to us as tax deed investors. And one thing you don't want to do is you don't want to kid yourself. You want to, you know, figure out what you could sell it for if you had to. You know, I'm always going to take the lowest comparables I can find as far as what my that property's worth. I want to be on the low side. You know, I don't want to overinflate the price in my mind because I'm the investor. You're the investor. And so, you know, be honest as you go through and evaluate the property. That's going to help you determine that opening bid. That's the same thing as looking at tax lien investing. You know, as far as foreclosing and acquire property through tax liens, you know, you're usually going to foreclose on tax liens that have more than 1 year's worth of property taxes, because it's going to be harder for a property owner to pay off, you know, when you start the foreclosure process, that makes all of those property taxes due. So, you know, the property owner may have not paid for the last 4 years, and now you're going to foreclose. They have to pay all 4 years of them. So suddenly, you know, something that may be a $6,000 or $7,000 amount suddenly, you know, becomes a $20,000 or $30,000 or $40,000 amount, and the property owner is going to have a lot harder time paying off that on a $200,000 home, for example, than if it was, you know, $6,000. And so with tax and certificates, there's ways to acquire property as well. You just want to look and see how much is that lien value versus the property value. And so this is what you're going to think of as you go through and look at different investments. For tax deeds, you know, you want to look at it. What are you willing to pay for it? Am I willing to pay 50% for the property? And can I make profit on it? If you can make profit, then it's a good investment. You can turn around and sell the property quickly. You could do a little work on it, sell the property for a higher value. There's just a real lot of options. And with tax and certificates, if you don't, then you're going to make that good interest rate return. So this is a website that I like to use for finding county websites. It's called NACO.org. Now, we're going to go through it online in just a minute, and so we won't go through all the details. But what the NACO does is it allows you to research county websites. It has all of the county websites there. And so as you go through, you can click on Florida and look at all the different counties. Click on the county and review the county information. Now, as far as, and the reason I bring up NACO is because as far as tax lien and deed investing, one of your greatest tools, one of the most important things you need to learn how to do is to navigate county websites. The key to conducting due diligence is the ability to navigate these websites. The county websites are going to contain the information we need. They're going to have the tax information. They're going to have the property data. They're going to have maps. They may have registration. They're going to have the tax sale list, the auction information. They're going to have all the information we need as investors, or at least a lot of the information to figure out a property, to review the property records, to see when the property sold. And so really your ability to go through and research these county websites is going to be, you know, one of your greatest tools, and one of the things that you're going to need to learn to be a great tax lien and deed investor. Now, these county websites, they really can be one of our greatest tools. The key to conducting due diligence is the ability to navigate them. So as far as county websites, there's different departments that we're going to look for. Now the state profiles will go through and talk about some of the different county departments that you'll need to contact. But usually there's two different county departments. Now the first county department is going to be the assessor, the property appraiser. That's where we're going to go to figure out how much is a property worth, what's the assessed value. You know, sometimes they may have pictures of the property. It's where you're going to get all of that property record information. Also, the treasurer, tax collector. They're many times going to be the person that handles the collection of the property taxes. And usually the person that handles the collection of the property taxes is going to be the person that's in charge of conducting the tax sale. If they're not at least the person that's in charge of conducting the tax sale, they're going to know who does. And so, you know, the tax collector is another department that you're going to look for. So as far as the treasurer, they may be called sometimes by different names. They can be called the treasurer, the tax collector, the finance department. It's really the person that handles the property taxes. Many times they're going to have the auction calendar, the upcoming auction information, the tax sale list, over-the-counter information. They're also going to have the past property tax record. And so that's something you can look at in looking at in purchasing tax liens. Say you're purchasing an over-the-counter tax lien or a secondary market lien, you know, you're going to want to see what those past tax records are in case you want to foreclose on the property. You're going to need to pay those to be able to foreclose so that you become the only lien holder. And then that gives you the foreclosure right. Somebody could do that before you if they have an earlier lien and they can foreclose and they're going to pay off your lien. And that's where you're going to make your money back if another property owner forecloses because they want to try to acquire the property. It just depends on the tax lien certificate. As far as the appraiser, they conduct a property evaluation on every piece of real estate within the county. So they keep and update all of the real estate records. We're going to use their parcel search tool to research property records. We can research them by the address. We can research them by the owner. Usually the easiest way to research property is by the parcel number. So we go to that parcel search tool. We type in the parcel number. We can pull up those property records. And property records will vary from county to county, but they're usually going to have a lot of good information. They're going to include the lot size. They may have a map, overhead map. They may have a mapping system. They're going to have the improvements, the zoning, the property values, and sometimes photos. So there's going to be a lot of good information. That's the first thing I check when I'm looking at a property. Is I'm going to check the property record, see what the county says about the property and has about the property. So the parcel search tool, we can search by different criteria. We can search by the address, the owner, the legal description. Once you found the parcel search tool, then you can click on the enter, click the enter button, and it's going to go ahead and pull up the property records. Another good tool of the property records are the maps. You're always going to want to check out the maps. That's going to give you the overhead version. You're going to be able to see lot lines, and some maps are very interactive. So as you go through and get serious about a property, then you're going to want to check all of these different options out. You want to find all the information you can that's available on the county records. So as evaluating property, the property assessment of value ensures the investment security. And so different investments are going to require varying degrees of research. The more money you invest, the greater you're going to research. High yield tax lien investing requires that the property just has adequate value. The lien has a good lien to value ratio as well. You know, if by paying the tax and certificate, if you have a good chance of getting the property, if not earning your interest rate return, then it's a good investment. Because either way, you're going to get the property or you're going to earn your interest rate return. Now, as far as property acquisition investor or a tax deed investor, you know, you're going to need to know more specific information about the property. Now, here are some of the things that we're going to be going over over the next couple of weeks. Reading tax sale list, determining your qualifying factors, narrowing down your selection, pulling up county records and property records, researching the risk, using Zillow and Google Earth, determining the property value, defining your potential investments, refining your qualifying factors, determining your maximum bid, bidding at the auction, And so these are some of the things that we're going to be going over the next couple of weeks and going through and talking about. So what is over-the-counter investing? It's a question I get a lot. Over-the-counter investing is purchasing tax liens and deeds after the auction has taken place. And so there's lots of different over-the-counter type lists. There's tax lien list, there's tax deed list, there's redemption deed over-the-counter list, and there's the secondary market tax lien list. And so these are all tax liens that you can purchase without going to the auction, without bidding down that interest rate. You're just paying whatever that interest rate is.